Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast.
Hello, hi, hey, welcome. Episode 53 of the Financial Purpose Podcast. Glad you're here today. I'm going to talk about a little bit of an economic overview today, and I'm going to be reading from an email that I sent out to clients last week. And this is one that I kind of wasn't really going to talk about on the podcast, but I had one client send me feedback because what I did is I sent this email with an economic update and said, here's what I'm thinking, here's what I'm watching, here's where I think this might be going. I will send a follow-up with some recommended adjustments to the investment portfolio. And so I did that, both of those emails a couple of days apart, and clients sent back feedback and said, hey, that last email with all the charts was a total banger, and this one with the strategy adjustments, not so much on the visuals department, but helpful information. So I figured if it's really a banger, I don't know, the client could have been pulling my leg, because sometimes my clients do that because we have that kind of relationship where we can give each other, a little bit of grief, and that's great. But maybe it is a banger and we should talk about it. So I thought I would share it with you, the podcast audience. If you're watching, there's going to be some charts. If you're listening, I'm going to do my best to describe what you're seeing on the charts. But I do recommend, as always, especially when there's a visual, go back when you have time, watch the episode, see the charts, jot down questions, drop them in a comment or send them over to info@lifemoveswealth.com, and always happy to discuss your thoughts, what you're seeing, and your questions. So getting into it, you've probably heard the famous quote. It's Wayne Gretzky said it in the 80s when he was asked about how he's been so successful as a hockey player and winning the Stanley Cups and all of that. Is the quote is, "I skate to where the puck is going, not to where the puck has been, or even where it is at that time." And that quote is always attributed to the great one, Wayne Gretzky, but legend has it, it's actually advice that he received from his father, Walter, when he was younger and learning how to play hockey and developing the skills. So in the same spirit, I think it's compelling to look at where the puck is going economically. And I sent a video around August 5th to clients of Life Moves Wealth because we had a big market drop over the period of 2.5 days. And I had a couple clients reach out and say, oh my gosh, do we need to do something? Should we be selling? Should we be, moving to cash and that kind of thing? And so I sent a video message. It was about 7 minutes long or so. And there were probably 5 or 6 reasons why the market did what it did on that day, and or over those 2 or 3 days. And so I just said, here's this, here's this, here's this, here's this, here's what we're watching, here's why we're not panic selling, here's why we're not doing anything. And as always, if you have cash on the sidelines and the market goes down, you should always buy more of the quality investments that you hold rather than being nervous, right? That's always the time to go in. And even if the market's going to continue to drop, you're still able to buy as things get discounted. It's like a Black Friday sale, man. Like all of your favorite brands are on sale. They're 5% off or 10% off, which is what happens in the stock market. And for some reason, the stock market is up, 13% or 14% this year, whatever it is, and it goes down 3%, and we panic. And so I wanted to help some of the clients who were just a little nervous about that understand what was going on and really why it wasn't something that I felt the need to do anything urgent around. So everything that I talked about in that video on August 5th, and again, if you want a copy of that video, send an email to info@lifemoveswealth.com. I'll be happy to forward you the link so you can see it as well. Like I said, it's about 7 minutes long, and by now it's 3 weeks old, so the information's not really all that relevant anymore. It's kind of outdated, but some of it still is good context for where we're going. And everything that I talked about in that video confirmed that the market and the economy in particular really is slowing down. And we're not stopping. It's not coming to a halt. None of the indicators are currently pointing toward a recession. So we're not like on the cliff, if you will. But we are slowing down, kind of like in a plateau. Or I heard an analyst on a call last week describe it as kind of like being in a glider. And if you've ever been in a glider or played a simulator with a glider, if you don't have an updraft in the wind, the glider can't continue to fly. And so it'll just kind of coast into the wind. If you get an updraft, it'll go up. And if you get a downdraft or no updraft or no wind, the glider will just kind of glide down, and that's what it does. So I thought that was a great analogy for where we are economically, and so we're going to talk about that. Now, for the TLDR folks, too long didn't read or too long don't want to listen to the whole thing, let me just skip ahead for your benefit, you people with short attention spans. The economy is showing signs of slowing. It's confirmed in the charts, which if you're not going to listen, you're going to miss out on. So just hang out. But anyway, if you got something better to do, it's important to note that the data is not confirming or even pointing to a recession yet. And I just said that. But there is a lot of data to watch over the next coming weeks, and especially heading into the September Fed meeting, and the next couple of jobs reports are going to be very important. So, and I'm going to talk about jobs a little bit later because I have some new data on that front that just came out today. So, and today is Wednesday, December 21st. The Fed is currently in Jackson Hole for their annual summit. We're going to get some guidance from the Fed. Jerome Powell is supposed to speak today. We'll get an idea of kind of what they're thinking. He's probably going to set the stage for a couple of rate cuts. And I do expect the Fed to cut rates in September. I believe they should have cut in July and started that process. They did not. And so the odds are growing that there's going to be a 50 basis points cut in September. Some people say that's too much. It actually might be appropriate. I think that they'll do 50 in September. I think they'll do 25 in November and then cut another 25 in December, and that'll be a full 1 point or 1% or 100 basis points rate cut for 2024. And then who in the world knows what's going to happen in 2025. And a lot of that really is going to be driven by what the economy expects under whatever administration we have as both in the White House and in the composition of the House and Senate. So the elections do have some sway over what happens, and largely that sway is going to be around tax legislation, because our current tax law is scheduled to sunset December 31st of 2025. So whoever is in power will write the tax law, and how the tax law is going to be shaped will largely determine business sentiment and how the economy is going to go past that. So because of all of this, again, trying to look at where the puck is going, if we do have a slowing economic environment, I do want to, for clients of Life Moves Wealth, I've recommended and started implementing a couple of portfolio adjustments just to take a little bit of risk out, to move money kind of away from higher growth and broaden out a little bit. The market has already started to do that. The market's been very concentrated for the past year and a half in just a handful of companies, largely the Magnificent Seven, or the Mag 7, as you may have heard it, and AI related stocks. And so kind of moving away from that a little bit. Not that AI is going anywhere. A couple episodes ago, I talked about the importance of semiconductors economically. I'm not changing my stance on that whatsoever. But if we're going to move away from some of that high growth stuff and kind of broaden out a bit, that's really what we're doing. We're staying prudent. We're not going to cash because cash rates are going to come down. There's some argument about whether or not you should lock in cash rates. Now, I see opportunity cost there, because if you lock up your money just to get a high yield, you really can miss opportunity in other parts of the market, especially if we do see some other leadership changes that produce a better return than the cash. It could also be possible that that's a winning strategy. If we do see the market soften up, you could actually be earning more than the market. And so we never know. But cash rates are going to come down. I do think cash is an important part of any wealth management strategy. How much of that really depends on you and your situation and all of that. But nevertheless, we're going to stay invested. It's the most prudent thing to do, because again, when you go to cash, you miss out on opportunity, you miss out on rebound days. There's a lot of data around missing the 10 best days of the market and how it really, really harms your returns over time. But anyway, when the market's correct, if they do correct, let's add to positions. Everything goes on sale. Let's buy stuff when it's on sale, especially the stuff we like. So that's the TLDR part. If you stuck around, keep sticking around because we're going to go to some charts. I want to paint the picture of what we're seeing with some charts, give you an idea of what I'm watching in the data. All of the commentary and pointers shown in the charts, if you see little additions in red ink on the charts, those are my additions. So just know that the charts are, most of them come from either TradingView or Y charts, or they're going to come from Koifen, which are kind of a couple of the services I use to analyze data. And so some of my notes are on here. So first chart is going to be of the S&P 500 going back about a year. This is going to show you why we don't panic sell. Now, I made this chart a couple of weeks ago. Actually, no, I made this chart last week because this is the one that I sent out to clients. And so this chart goes back about 1 year. The long-term average, which was established last October when the market kind of bottomed, because we did have a period in August and September of last year where the market did go down. It bottomed in October, which is interesting because it also bottomed in October of 2022. So hang in there through that, right? So there's some seasonality of the market. But anyway, from October all the way up to currently, the long-term trend has been up and very strongly to the right, with the exception of April's 5% correction. And then you can see on the chart, there's a blue circle up near the top right of what happened at the tail end of July and into the beginning of August. And that happened for multiple reasons. The biggest reason is it literally is the yen carry trade kind of sparked all this off, and it went to a risk-off thing. And the reason why that matters, if you're like, who's carrying yen? What is yen? So yen is Japanese currency. For the long time, yen has been very cheap. The Bank of Japan has kept rates really low. And so you could borrow against the yen and use that to buy higher yielding assets, and you'd get an arbitrage there and make more money and then pay back the yen with smaller dollars, right? Well, the Bank of Japan is raising rates, and they're the only central bank in the world that is currently raising rates. Everybody else is cutting or is staying stable. So that spooked the markets because if that, if you can no longer do that arbitrage, that's going to force the sale of some assets and close short positions and things like that. It's all technical. But what the chart shows is outside of that happening in August, the trend's been upwards. And on the chart, you can see some green bars that are vertical and some red bars that are vertical. And those are just days where the market closed up green or days when the market closed down red. How big the bar is depends on how wide the market traded. On the chart, you'll see a couple of moving average lines. You'll see key resistance and key support levels. I just want to talk about those real quick because I did have a couple of clients say, hey, I'm not really clear on what that means. Resistance line or resistance level is basically where you can see that the stock or the market or the index or whatever you're watching has reached a certain level, and then it kind of just fades out right there. And can't really go much higher than that. Or if it does go higher to that, then you'll see it, as in this chart, it went above the high resistance level and then fell back to it and then fell below it. So the reason that line is green, that's a horizontal dotted line. That's green because if the market or the stock or whatever we're watching stays above that resistance level, we make more money. A couple lines down, you'll see a key support level, which is just the opposite. It's where a stock has basically found support or a bottom and just kind of rides that out. That line often will get retested from a technical standpoint, and support level is just where we've seen the stock or whatever the trade is stop going down, and it's red because if it goes below that level, then we start losing value at that point, right? So that's it. The continued the continued direction of the market. Over the next couple of weeks from here, I actually pulled this chart up again today. The green bars are back above the long-term trend line that's going up and to the right. And what happens from here really depends on what's coming out on data. Today, the market is soft, relatively flat, last I checked, because we got some jobs information, which I'm going to get to in just a minute. And earnings season is mostly over, so we don't really have corporate earnings or guidance weighing much on the market. The next earning data is going to come out in mid-October. That's going to be pushing really close to the election. I expect that to be some guidance to be soft there. I think that there's a lot of corporate CEOs that are just going to be unsure of what's going to be happening and how they should plan because of tax rates. If the corporate tax rate increases, which is part of the Harris agenda, that tax increase could be massive for businesses as a percentage. So because we're going to go from 21% to possibly 35%, that's a big damn deal. That's huge. That wrecks a lot of planning for growth and balance sheet health and things like that. So there's going to be some pensiveness as far as what's going to happen. If we do get a Trump administration, then he's probably going to push to make the Tax Cuts and Jobs Act permanent, which is going to lock those rates in for the long term. The markets will love that. Companies will like that because they'll be able to plan around it. So we'll just have to see what happens. But there's going to be a lot of distractions between now and the end of the year, and the Fed and the election and jobs and things like that are certainly big players there. So moving on to chart number 2, this is the CBOE, the Chicago Board of Options Exchange. This is their VIX index. It's often called the fear gauge, but it really just measures 30-day expected volatility of the stock market based on the volume of options or calls and puts. And I added a few notes for spikes, and I sent this thing back about 15 years. And I wanted to put the August spike into perspective because how quickly it went up. I mean, we went from a VIX reading of about 12 all the way up to, it was like near 60. At one point, it spiked up and then kind of settled down a little bit. And that kind of a spike should have been, according to the prior 15 years, a economically vitally important event, and it really wasn't. I just talked about the yen carry trade that kind of spiked that volatility. It did have broad global market impact, and it still could. It could actually determine how the dollar trades. That will determine how the stock market trades. That will determine how bonds trade, all of that. So it does have some importance there. But it was a massive spike. It was very short-lived, and today the VIX is all the way back down to where it was. It's under 20, and the market's just kind of trading orderly. So if you look at this, we had the yen carry spike. Go back to 2022. We had the inflation rate hikes, which was a big event for the economy and for the market. The spike prior to that was COVID. Prior to that was the government shutdown in 2018. We had a big sell-off right before Christmas. We had a big rebound the day after Christmas. Earlier in 2018, the Fed was in a period where they were slowly raising rates. We had an extended period of gains, so there was a pullback. It was like February of 2018, and so we saw a little bit of volatility spike there. In 2016, the yuan was devalued by China. Yuan, whatever, however you say it, yuan. Devalued by China. That was August of 2016, August 24th, if my memory serves. I remember that day pretty well. Going before that, we had the credit downgraded back in end of 2011. In 2010, we had flash crash, which was flash crash. I'm getting tongue twisted here. That was the flash crash was high frequency trading, and it was limits that were triggered in the market that actually shut down the market for periods of time to let things kind of settle out, let things cool down. And that was a really big deal. And then before that was the great financial crisis. And if you kept going before that, then it would be the dot-com bubble. And if you kept going before that, it would be, somewhere in like 1994. And if you go before that, 1986, right? So on and on. These are big events. And what happened 3 weeks ago probably won't really be remembered as being a big market mover, but it really was. And so we'll see. Anyway, because we had that 2-day spike, 3-day spike, and it's come right back down, all the more reasons why we don't panic sell for these kinds of things. We want to understand what we're seeing and see if we have sustained volatility or just a quick spike, and that's where we are. So that's all the market stuff. I want to look at now the economy, because these are going to be the bigger movers of what happens in the market. And we're trying to take a look at where the proverbial puck may be going. So we're going to bring up a chart for core PCE, which is the basically the personal expenses index. And so this is showing what's called core PCE. Now, this is the Fed's preferred measure of inflation. A lot of people are looking at the Consumer Price Index, or CPI, which is going to be a little bit higher in most cases than PCE. But the Fed likes PCE because it actually indicates exactly what the household is spending. And core means that it excludes food and fuel costs, because those have the highest frequency of price swings. And the tricky thing about core PCE is that it doesn't include food, and food inflation, I should say, maybe groceries and otherwise are where we're seeing people really struggle a bit with just adjusting their balance sheets and their budgets and things like that, because it just costs more money at the grocery store these days. And so this isn't really reflected here, but you can see that the long-term average of PCE is about 3.24. We're currently at about 2.67 or so. 2.63 in June. And July's numbers have not yet been published. We should actually be seeing them, I think, this week, possibly. So anyway, we're below the long-term average. We're below the spike that happened in July of 2022. And so the Fed is comfortable with where we are on inflation. So they're shifting away from fighting inflation, which is why the rates were increased and they kept raising them. And so now they're looking at the other side of their dual mandate, which is maximum employment. And so we should probably kind of move that direction. So let's talk about unemployment. First chart that you're going to see here is going to be the U.S. unemployment rate. It jumped up to 4.3% in July. The long-term average, by the way, that sounds like a lot, but in July of 2023, it was only 3.5%, and it had been in the low threes, 3.5, 3.4, for a long time coming out of the pandemic. And so it jumped up to 4.3. It jumped up pretty quick because in June it was only 4.1. So we got a 0.02% increase. The long-term average is 5.69, so we're still well below the long-term average, but still at a point where the Fed is starting to say, okay, we need to look at what the job market's doing and see what that is. And when we have a quick jump in the unemployment rate, that's going to get some attention. So that unemployment rate at 4.3 gave traders a little bit of the jitters at the beginning of August. That was one of the reasons why we also saw quick volatility. It was like a couple of dominoes stacked and they all tumbled. Unemployment was one of them. However, the jitters were calmed last week with an initial unemployment claims coming in at 227,000, which was quite a bit lower than the 250,000 that we expected. Now, I took this back. The next chart is the initial claims, which is where we're going. I took this back pre-pandemic, and I added a line for March 7th of 2020, which was the last payroll report that we got before everything was shut down. So for context, that week we had 213,000 unemployment claims. January 6th of 2024, we had 198,000. And last year, middle of August, we had 250,000 initial claims. So that's a lot of numbers that are kind of bouncing around. You're like, what did you just say? All I'm saying here is that this bounces around quite a bit, but we still had just a little bit more jobless claims than we did going into the pandemic when things were already starting to get a little funky around the beginning of March. So take that for what it's worth. But Here's why this is important. And I'm going to share data that came out today. So the trouble with initial claims that we get on a weekly basis is that we all know that they're not accurate, and they always get revised down, and they get revised down every month by the Bureau of Labor Statistics. And so we just got today the report of their annual review, which had a downgrade, and there was a lot of questions about how big this downgrade would be. So here's the number. The U.S. economy created 818,000 fewer jobs than initially reported during the 12-month period through March of 2024. And that came from the Labor Department this morning. So 818,000 less jobs than what had been reported. That might be a little bit of a confirmation that we have some weakness in the labor market, and the data really needs to be massaged a little bit more. And actually, I got to think that hurts the Biden and Harris talk points, because they have been on the rails about how many jobs that they've added and how many jobs that the prior administration lost. Never mind that there was COVID in the middle of that, and they shut us down, and so we had to lose jobs. Whatever. I'm going to get on a soapbox with that. So anyway, don't claim numbers that you can't take credit for. Anyway, so I'm sure that hurts their talking points, because that's almost 1 million less jobs that they created, air quotes. So the Bureau of Labor Statistics said that job growth was nearly 30% less than the initially reported 2.9 million jobs from April of 2023 through March, the end of March of 2024. And the report could be seen as an indication that the labor market is not as strong as previously thought or reported, and that could provide further impetus for the Fed to start cutting rates. So here we are. We got this number. I really want to see what Jerome Powell says about it. And I think that just further confirms my suspicion that we'll probably see a 50 basis point cut in September. But anyway, what I'm watching here, this is probably now going to change, seeing these numbers. There was, at that time when I sent this email last week, the 4-week average was about 237,000 claims. If it went above 250,000, that would be a concerning signal. We were adding about 170,000 jobs through the summer. And if that number gets revised down and drops below 125,000 on average, I think that's also going to be a concerning signal. And that's important. Why it's concerning is because the American consumer drives the economy. So if inflation is truly coming down, but the labor market is showing weakness, it begs the question, will the consumers continue to spend? And that's we're starting to see data. I actually saw a report from Home Depot today that said that people aren't really spending very much on typical seasonal home improvement items. They are buying the 10-foot skeletons, though, because they're on sale for Halloween. But they're really not that's true. I'm not making that up. But they're really not buying typical things. And so that it's showing the consumer is being very choosy with what they're spending. Now, travel is still kind of expensive. There's still a lot of people going through TSA numbers and that kind of thing. But recent data does show trends of the consumers. They're becoming more price conscious. They're spending less. They're spending less often, and they're just being more choosy. And the average American household, they've already spent through their pandemic savings. The data shows that. We're starting to see some weakness in credit card delinquency and auto loan delinquency data, which does not surprise me, because through 2021 and 2022 and 2023, the average price of a car loan went up to a little more than $717 per month. And now I think it's actually maybe went a little bit higher because interest rates are up. But we'll see what that looks like. But year over year, retail sales data, that's the next chart we're going to look at. That definitely confirms that. So you can see the movement over the past couple of years. I've got this back 10 years of consumer data. You can see where it's kind of dipped and where it's creeped up. And if you look back over the last couple of years, we had a big spike in the chart over 2021, 22, and then it started to slow into 2023. And 2024 is actually below the average. And so actually we're looking at I I think we skipped over to the PMI chart. If we go back to retail sales, there we go. So same thing. You can see that we had a spike there, and then we've actually come back. So the long-term average is 4.63%. For this index, we're at 2.55. So well below average. That data is definitely plateauing, showing some weakness, could be a sign of contraction. And retail sales, in case you're wondering, that index, that's total receipts of all retail stores as a broad group in the country. And that's a really important number to watch, because that's going to give some insight into what fourth quarter data might look like. Because remember, fourth quarter is where a lot of retail money flows in, and it's because of holiday spending and Christmas and Hanukkah and whatever else you're celebrating. It's all in there, and people buy gifts, people spend money to host family, they travel, all of that. So this is going to be a very important indicator to watch. Among the more important indicators, and now we can go back to the manufacturing data. Thank you, Josh. Is this one? This is one of the key reports. It's one of the first reports that we get every month, and it gives us an early indication on month-over-month changes in economic activity. And this is the ISM Manufacturing PMI report. That's a lot of letters and acronyms. As I said, it's a key indicator. It is data gathered monthly from purchasing and supply executives in over 400 manufacturing type companies. And just to kind of get an idea of how it's calculated, there are 5 factors that are weighted equally. They're seasonally adjusted, and those factors are new orders coming in, production levels, employment in and out, supplier deliveries, and level of inventories. And basically here, this is showing a slowing trend. This data has been weak for most of 2024. We've been watching it closely, but generally, if we're above a level of 50%, that means that we have an expanding activity in manufacturing. If it's below 50%, then it's contracting. And if it's below 50% for an extended period of time, that's a trend, and that shows slowing. And that's definitely what we're seeing here. And not only in the manufacturing, but also in the non-manufacturing, which is the next chart. And this is for services data, and this is the last chart, actually. And this is for companies that are non-manufacturing, they're service-related. Same thing, data gathered from purchasing and supply executives of more than 400 service firms. And these are things like restaurants, food services, agriculture and fishing and gaming, arts and entertainment, educational, healthcare, finance, real estate, warehousing, all of that kind of service-related stuff. And it's very much the same as the manufacturing. If we see sustained level above 50%, we're in expansion. If we see a sustained level below 50%, we're in contraction. And we're kind of dancing right on the line. We've been bouncing up and down. We're at 51.4 for the month of July. And so this is going to be another key indicator to watch. So after seeing all of that, I just confirmed over a few charts, we are in a slowing period. It just is what we're pointing to. And so the question may be, what do we do next? And a slowing environment with falling rates, traditional areas where investors seek some form of safety and some form of yield are areas like investment grade bonds and utilities and value stocks and things with reliable dividends and possibly real estate, just to name a few. And so investment portfolios that are managed by Life Moves Wealth already have exposure to those areas. And the changes that I recommended to clients is that we just broaden that out a little bit, reduce some of the current overweight that I've had for the past year and a half in high growth areas, and just broaden out a little bit. And clients of Life Moves Wealth, they did get details this past week on those specific recommendations. A lot of those have been implemented, and some of those are just ongoing discussions with clients just to make sure that they understand what's going on. So if you're thinking about the economy, if you've listened to this, if you've seen the charts and you're not sure what it means for you or for your business or for your investments, I would love to have a chance to talk with you. Send an email to info@lifemoveswealth.com or go to lifemoveswealth.com, and in the bottom right corner, there's a little button there that says schedule time with me. Click that. You can see my calendar, pick a day and time that works for you. Happy to talk about any of this in a way that makes sense to you. And of course, we can always talk about what's going on with your financial goals, define your financial purpose. I can walk you through the approach that we use for that. Really, that level of advice and direction, it's going to give you a little bit more confidence, especially, and maybe a lot more confidence, quite honestly, especially if we're in a situation where things are just maybe looking a little bumpy and uncertain. I don't guarantee certainty. I don't do that. I can't do that. It doesn't make sense. Nobody can be certain about really just about anything. And especially when it comes to, the markets and the economy and things like that. But we can certainly create some things and put some barriers and put some guardrails in place where at least we know if this happens, we have it covered here. If this happens, we have it covered there. If this happens, we'll make adjustments over there. That kind of thing. It's all very helpful. So again, I hope that you've enjoyed this. I hope it's been helpful just to kind of give you an idea of where we are, where things are, because last week I saw the word recession more often than I had seen it since 2022. And so I want to be sure that anytime that we're looking at this, that it doesn't generate any like panic or fear, that it really just helps you see that we're still okay. We're just slowing down a little bit, and things can always turn fast one way or the other. And we'll continue to watch it, and I'll continue to watch it and keep letting you know. So again, questions, comments, drop the comments into the video or wherever you're seeing this or listening to this, or shoot an email to info@lifemoveswealth.com, and I'd love to talk to you there. So that's all I have for you today. Until next time, take care. Go be financially awesome. See ya.
Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.